Hey everyone, welcome back to Corporate Decoder. Today BENFW just filed a current report on Form 8, and I'm seeing a significant cash infusion that investors should know about. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing details a new loan that could be converted into a lot of shares, and we need to dig into the terms. Let's start with the basics of the company. Beneficient, as they are known, has two main types of securities traded. There are their class of common stock, which trade under the ticker BENF, and then there are their warrants trading under BENF. These warrants give the holder the right to buy shares of common stock and also a special kind of preferred stock. The company is incorporated in Nevada and has a central office in Dallas, Texas. This particular filing is a Form 8K, which is used to announce major corporate events that shareholders should know about immediately. The most important date here is the 5th of August 2026, which is when the earliest event reported in this filing occurred. Beneficient is classified as an emerging growth company, and they have elected not to use the extended transition period for new accounting standards. Looking at the securities registered, we see the class of common stock BENF is traded on the Nasdaq stock market. Their warrants BENFW are also listed on the Nasdaq. This tells us these are actively traded securities. Now, let's get to the meat of this filing, which falls under Item 2.03, dealing with new financial obligations. The company previously had an agreement called a Standby Equity Purchase Agreement, or SEPA, with a company called B.E.N.F Limited, or Yorkville. This original agreement allowed Beneficient to sell up to $250 million worth of its class, a common stock to Yorkville over a 3-year period. However, on the 26th of June 2026, they entered into an amended and restated SEPA, the A&R SEPA. This new agreement has a few key changes. First, the total amount Beneficient can sell to Yorkville is now reduced to up to $100 million. More importantly for this filing, Yorkville will advance the company $4 million. This advance is structured as promissory notes, which can be converted into shares of Class A common stock. The first part of this advance happened on the 30th of June 2026. Beneficient issued a promissory note to Yorkville for $2 million. There was an original issue discount of 5%, meaning the company received about $1.8 million in cash after the discount. This first closing happened on the 1st of July 2026, and this is where the current report comes in. On the 5th of August 2026, Beneficient issued a second promissory note for another $2 million. This also came with a 5% original issue discount, bringing in another $1.8 million for the company. This cash was received on the same day. So, in total, these two notes represent a $4 million loan that can be converted into stock. These promissory notes are due on the 30th of June 2027. They carry an interest rate of 5% per year. But here is a critical detail: if an event of default happens and isn't fixed, the interest rate can jump up to 18%, or whatever the law allows to be the maximum. Now, about the conversion, Yorkville has the option to convert these notes into Class of common stock. The conversion price is where things get really interesting and potentially dilutive for existing shareholders. The conversion price is set at the lower of two figures. The first is a fixed price of $5.6064 per S-hair. This price was 150% of the volume, weighted average price, or VWAP, from the day before the first note was issued. The second part of the conversion price is dynamic. It is 92% of the lowest daily VWAP over the 5 trading days before the conversion. Crucially, there is a floor price of $0.89 per S-hair. This means even if the stock price drops lower, the conversion price won't go below $0.89. However, the company can actually lower this floor price with notice to Yorkville, which is a point of concern. If we assume the notes convert with 5% interest, the maximum number of shares that could be issued from these notes is 4,719,101 shares. This number is subject to something called an exchange cap, which limits how much of the company's stock can be issued in total. Also, there is a beneficial ownership limit. Yorkville cannot convert the notes if it would mean they, along with related parties, own more than 4.99% of the company's outstanding class, a common stock, immediately after conversion. The company notes that the main terms of this agreement and the promissory notes were already talked about in their annual report, Form 10K, filed on the 30th of June 2026. As for the exhibits, we have the amended and restated Standby Equity Purchase Agreement, which is listed as Exhibit 10.1. This document is incorporated by reference from a previous filing. Exhibit 10.2 is the form of the promissory note itself. This is also incorporated by reference from their annual report. The filing also includes the cover page interactive data file, which is standard for electronic filings. Finally, we have the signature section confirming that the company is officially filing this report. The report is signed by Gregory W. Ezell, the Chief Financial Officer, on the 11th of August 2026. So, what does all of this mean for Beneficient and its shareholders? This filing shows the company is taking on debt, specifically $4 million in the form of convertible promissory notes. While this provides immediate cash, the conversion terms are a big deal. The conversion price is tied to the stock's market price, with a floor that is significantly higher than the current trading price of the warrants, which are hovering around 1 cent according to recent news. The maximum number of shares that could be issued, over 4.7 million, represents a substantial amount of potential dilution. If Yorkville converts these notes, it could significantly dilute the ownership stake of existing shareholders. This is especially concerning given the company's recent stock performance. Where the warrants have been pinned at a very low price, think about it like this. If you own 100 shares and the company issues another 4.7 million shares, your 100 shares now represent a much smaller piece of the pie. Historically, companies that issue convertible debt, especially with these kinds of floor prices and discount mechanisms, often see significant share price pressure. It is a common way for companies needing cash to get it, but it comes at a cost to existing equity holders. The risk I am watching is how this potential dilution impacts the stock price, especially if Yorkville decides to convert these notes at the earliest opportunity. The fact that they can convert at a price significantly higher than the current market value of the warrants suggests they might be looking to exit their position or capitalize on the conversion terms. This is a classic dilutive financing move, and it is essential for investors to understand the potential impact on their ownership percentage. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.